Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today we're gonna do an ETF battle, one that I keep getting messages and emails about to do. Can you please do QQCL, the Global X Enhanced Nasdaq 100 covered call ETF versus QQQY from Evolve ETFs, the Evolve Nasdaq Technology Enhanced Yield Index Fund. So a lot of you have been asking me to compare the two. Why do I personally own QQCL and not QQQY? So in today's video, we're going to do a deep dive and we're going to compare the two ETFs, and I'm going to tell you why they're really not that comparable if you ask me, but I'm going to do the comparison anyway. So first of all, if you like these types of videos, hit the thumbs up, the like button. I would really appreciate it. And by the way, keep sending me messages and comments on YouTube of videos that you want to see, because I'm here to make the content that you guys want to see. Even if I don't respond to everyone's message, guys, I typically read most of my messages. So if I keep getting the same request, of course, I'll make the video. So first, let's actually analyze very quickly, high level, what these two ETFs are. And then I'm going to give you the four main differences between them. So QQCL is very simple to understand. It's a Nasdaq 100 index with covered calls and 25% leverage. So they are writing NDX or Nasdaq 100 index calls for the covered call writing. Leverage of 25% as well. So that's another important thing to remember. So QQCL is basically the leverage version or the 25% leverage version of QQCC. So Nasdaq 100, and what is the Nasdaq 100 index? Should all know what it is, right, guys? It's a very, very popular index. You could just Google Nasdaq 100 holdings, and this is typically known as the tech index because it's very technology focused. Why? Because these are only 100 companies. The Nasdaq 100 index is 100 non-financial companies listed on the Nasdaq, the top ones on the Nasdaq exchange, non-financial. Remember, in the US, there's two main exchanges, Wall Street or the New York Stock Exchange. There's also the Nasdaq Stock Exchange. They're both in New York, but the Nasdaq 100 index is going to have only stocks listed on the Nasdaq, whereas, for example, the S&P 500 has 500 companies listed on both exchanges. So it's about 50% technology stocks in the Nasdaq 100. Some people think it's actually more than that. It's only 50% of the stocks on the Nasdaq 100 index are technology, and you could see the top ones here. So of course you have Nvidia, Microsoft, Apple, Amazon, Google, Meta, Tesla, Broadcom, Netflix. But you also have things that are kind of non-technology as well, like Costco and AstraZeneca, T-Mobile, right, communications, Pepsi, a couple of other things. So yes, a lot of the proportion is about 50% is technology, but there's other stuff too. Okay, so that is basically QQCL. The yield right now is about 15.5% because their latest distribution went from 27.5 cents to 29.5. They didn't update it, and by the way, you could see here that information technology is the top sector. Just like I said, about 50%. But you have also other stuff like consumer, healthcare, utilities, blah 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 blah, etc. etc. Another thing, the fee is 85 basis points. Of course, the MER is going to be pretty high because it includes leverage costs. Don't forget that, guys. It includes leverage costs, the 25% leverage. This is why I typically always look at the management fee more importantly. So it's 85 basis points. Okay, so easy. Nasdaq 100 with index with covered calls and 25% leverage, and they're doing calls on the index, index-based covered calls, or NDX calls. If you just Google NDX, you'll see the Nasdaq 100. Okay, so super simple to understand. The Evolve Nasdaq Technology Enhanced Yield Index ETF, although the name, the Nasdaq is in it, it's a little bit different because this holds, and this is one of the main differences, is the holdings. It only holds the technology companies or the companies classified as technology in the Nasdaq 100, right? So the Nasdaq 100 index is not a pure technology index. It's considered a tech index, but it's only about 50% tech stocks. So this is a pure technology ETF. This is only tech companies. And what they've done is they kept the asset, it's market cap weighted, just like the Nasdaq 100, the S&P 500, it's market cap weighted, which means The bigger the company is, the bigger percentage it'll have in the Nasdaq 100, right? So they kind of kept that same thing, but they just kicked out all the companies that are not technology. They're not technology. So instead of 100, you have 45 companies, which makes me believe there's approximately 45 technology companies in the Nasdaq 100, right? So if you scroll down, if you look at the holdings, you'll see all the technology holdings, all the technology companies in the Nasdaq 100. Broadcom, Microsoft, Nvidia, Meta, just the tech ones. And you'll even be surprised to see Amazon is not there, Tesla is not there. Those are actually considered consumer stocks. Of course, Costco is not going to be there, Pepsi is not going to be there. So that is the main difference, number one, it's the holdings. QQCL is not pure technology, it's 50% technology, and it's the pure Nasdaq 100 index. This is the Nasdaq 100 index, but only the tech stocks in there. Only the tech stocks in the Nasdaq 100 index. But what I personally like about it too is it's also market cap weighted. That's why you see Broadcom and Microsoft and Nvidia and Apple have bigger percentages versus Intuit and Adobe. And the more you go down, the smaller the percentage is. So this is not an equal weight. This is also market cap weighted. Okay. The second big difference is the management fee. So I've told you that it's 85 basis points for QQCL, but QQQY Evolve, and this is a common theme of Evolve, which I really like. They have low management fees. It's only 50 basis points. So it's much less than QQCL. Another difference is the currency hedging. QQQY is hedged to the Canadian dollar, which means that if the Canadian dollar gets weaker versus the US, or the US dollar gets stronger versus Canada, this is going to negatively impact QQQY a little bit. QQCL is not hedged to the Canadian dollar. So if the Canadian dollar gets weaker, the American gets stronger, that actually benefits QQCL. Remember, you're buying both of these in Canadian dollars, but they hold US assets. So you got to remember, you got to realize if it's hedged to the Canadian dollar or not. So that's another difference. The MER, of course, on QQQY, I think we're going to have to look at the documents to find it, but I'm sure it's not going to be much more. It's probably going to be, let's see if we could find it here. Yeah, sorry about that. It's 72, the MER in 2023. I don't know if it's still the same one, but it's 72. Of course, the MER is going to be slightly higher than the management fee if there's no leverage. And of course, the MER of QQCL, by the way, is much higher. That's because it includes a leverage cost, right? So either way, the management fee is another big difference, much higher on QQCL than it is on QQQY. And last but not least, the other difference is the cover call strategy. So QQCL is writing, they both do up to 50% call writing. You could see that here on up to 50% of the portfolio, which means for both, about half the portfolio has no covered calls. So you're capturing the full upside of either the individual tech stocks in QQQY and the Nasdaq 100 index in QQCL. But this one is not writing index calls. They're actually writing calls on the individual stocks, on the individual names. You could actually scroll down and see all the call options. You see they're actually writing them on the individual stocks themselves, which you typically get higher premiums than if you're doing index calls, right? So this one has no leverage, guys, and the yield, sorry, I know I'm scrolling a lot. I have OCD, so I kind of move my mouse a lot. But this one has no leverage, and the current yield is approximately 17.65%. So it's actually higher. It's about 2% higher than QQCL, even without the 25% leverage, which is pretty impressive. So that's really the differences. There's quite a few differences between the two, and this is personally why I don't really do QQCL versus QQQY. This is not a pure tech play. This is a pure tech play. It's a pure technology stock covered call ETF. This is an index or Nasdaq 100 based covered call ETF. If we do a total return comparison between the two, actually QQQY is outperforming QQCL with dividends reinvested, even with dividends without reinvested. So if the technology companies only within the Nasdaq 100 are beating the Nasdaq 100 index itself, of course QQQY is probably going to outperform, right? Because you're isolating the technology stocks, and we know that technology stocks have done really, really well in the last couple of years. So QQQY, in terms of total return, I have to admit, like it says here, the numbers don't lie, is outperforming QQCL. Will that continue? I don't know. If technology companies keep outperforming the Nasdaq 100 index as a whole, then should keep happening. But it's fairly close, and you see that they do follow each other because, again, 50% of the Nasdaq 100 is in those technology stocks. But if technology takes a big hit specifically, you'll see that here. In April, remember when technology took a giant dip? You could actually see QQQY fall a lot harder than QQCL. That's completely normal, guys, because QQQY is only technology stocks, and QQCL has other stuff like Costco and Pepsi and healthcare companies, a little bit of utilities and real estate, etc., etc. So, in my opinion, QQQY, I don't think it's a matter of opinion. Of course, it has more concentration risk. It's going to be a little bit riskier holding QQQY versus QQCL, but QQCL has 25% leverage. This one does not. So I would say the risk level is approximately the same overall. But in terms of holdings, QQQY is obviously more risky because it has less and it's just technology, whereas QQCL is diversified. So what can we compare QQQY to? Well, in my opinion, you got to compare it to a pure technology covered call ETF. So in Canada, we have a bunch of them. We have HTA from Harvest. HTAE is a 25% leverage version. You have ZWT from BMO. You have QMAX from Hamilton. You have TXF from CI. So I just did a little performance calculator here. QQQY has not been out for 3 years, but we could do the 1 year comparison, the 1 year total return. So you could see 5% QQQY, 3.1% HTA, and you see a big difference, ZWT and QMAX. I figured out why. It's because ZWT and QMAX are not hedged to the Canadian dollar. The Canadian dollar has gotten pummeled in the last year versus the American dollar. So that is why there's a big discrepancy in return. But of course, if the Canadian dollar starts getting stronger, the opposite could happen. So in my opinion, the best thing to compare QQQY to is probably HTA, because HTA is not hedged to the Canadian dollar. They do have an HTA.B that is, it is hedged to the Canadian dollar. They do have a version that's not hedged, HTA.B, but HTA makes the most sense because QQQY is hedged to the Canadian dollar. They don't have an unhedged version yet. Maybe they will. It's less than 100 million. And by the way, I do an extensive Q&A with Raj, the CEO from Evolve, and we talk about QQQY in detail. Make sure to check out that video, guys. It's very easy. Just click on the name of my channel and just search Evolve, and you'll see, or QQQY, and you'll probably see the video. We talk extensively about it. I think he kind of regretted not adding 25% leverage to this one. But maybe they'll come out with a 25% leverage version in the future. I'm fairly suspicious that they will, to kind of do like, with bank, Utes and Oily does. I really don't understand what they're waiting for. I think launching a 25% leverage version of QQQY would be absolutely phenomenal, and the yield could hover around 20%. And I have to admit that if there is a leveraged QQQY, I would strongly consider adding it to my portfolio to complement QQCL. But of course, remember that you also have HHIS now from Harvest. But technology stocks make up the biggest portion of the S&P 500, which is a core foundational position in my portfolio. So I have a lot of technology stocks. So I don't know if I would get QQQY if they come out with a leveraged version, but I will definitely consider it. So hopefully I didn't forget anything. Give me a thumbs up. I would really appreciate it, guys. There you have QQCL versus QQQY. And really, just in short, in summary, the biggest difference is the holdings. QQQY only has the technology stocks in the Nasdaq 100. QQCL is the whole Nasdaq 100. They're both market cap weighted, which I like. I personally like market cap weighted, like indexes usually are. Big difference is the fee. Management fee is 85 basis points. Management fee on QQQY is only 50 basis points, synonymous with Evolve's very low management fees. The leverage, obviously a big difference. QQQY does not have it. QQCL does have it. And the cover call strategy. They're doing index or NDX Nasdaq 100 index calls. then they're doing the call options on the individual stocks on QQQY, which of course typically gets higher premiums than doing index calls. So yeah, they're similar in some ways, but they're different in many ways. So I actually consider QQQY as a pure technology covered call ETF. But remember, things like Tesla and Amazon, anything that's technically not classified as technology is not going to be included in here. So you're going to have more concentration in tech, less diversification. But of course, if technology companies do really well going forward, QQQY is going to do really well. So its main competition is really HTA. That matches perfectly because it doesn't have the currency hedging. It's currently outperforming HTA. HTA does have a management fee of 85 basis points, and it's I think the main reason why QQQY is outperforming HTA is because the technology stocks in here, the weights are equal weight. There's 20 and there's equal weight, whereas this is more market cap weighted, which means the better the company is, the bigger portion there's going to be. So of course, if Nvidia is beating everyone, Nvidia is 10% of this ETF, whereas it can only be 5% of this ETF, right? So I personally like market cap weighted. This is equal weighted. But in terms of other pure play technology covered call ETFs in Canada, you have ZWT, you have QMAX, you have TXF as well from CI. But I think QQQY is really up there in terms of one of the best, if not the best one for just technology. I just wish there's a 25% leverage version. So email Evolve, request it, everyone, and maybe our dream will come true. So again, hit that like button. What other ETF battle would you like me to do next? We did HYLD versus USCL. We did QQQY versus QQCL. Is there anything else you want to see? Let me know in the comment section below, and take care, everyone. See you next time.